Expectations firm for a September rate cut by the Fed. The yen holds steady after fresh jawboning. A strong Singapore dollar helps keep a lid on inflation there, and import data for New Zealand shows how some key sectors are struggling. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ senior rate strategist Jack Chambers looks at how the RBA is turning hawkish while other central banks start easing cycles.
It's unclear whether this was the RBA seriously considered hiking or whether it was just a means of jawboning. Because what we know is going to happen in Q3, and in the matter of actually just over a week, is that there will be a boost to real household disposable incomes.
But first in 5 and 5 with ANZ, I'm Alex Tarrant, standing in for Bernard Hickey, who's on a midwinter break this week. Global equity markets firmed overnight as expectations grew that the Fed can start cutting rates from September. The S&P 500 was flat at 4 a.m. Sydney-Melbourne time as a falling Nvidia share price countered rises in other industries. ANZ head of G3 Economics Brian Martin says there are signals that US inflation was soft in June as well as in May, providing confidence that the Fed can cut as soon as September.
If you take the data that we've had for Q2 on a monthly basis and annualise it, it is showing that annualised pace of inflation would have come right back down in the second quarter, indicating that the disinflation process has resumed. For financial markets, I think that is going to underpin expectations of rate cuts, and indeed that's exactly what we're seeing. The expectation for a cut of 25 basis points from the FOMC has firmed slightly today, with the market now pricing between 72 and 75% chance that interest rates will be cut by the FOMC when they next publish their summary of economic projections in September.
And the Aussie dollar was up 0.2% at 66.51 US cents, while the Kiwi was up 0.05% at 61.21 US cents at 4 a.m. Sydney-Melbourne time. Number 2. The yen held steady overnight at 159.70 to the US dollar. That followed renewed jawboning yesterday from officials. Here's ANZ head of FX research, Marjabeen Zaman.
We think that over the last few days, dollar-yen has really not moved in a very quick pace. Rather it's been much more gradual compared to what we saw in March and April. And so a cautious advance higher might be less likely to invite actual intervention at this stage. We also note that, as we have seen in previous instances, intervention has been not very effective in changing the longer-term direction for the currency.
Marjabeen says she still expects the Bank of Japan to raise interest rates by 15 basis points at its July meeting. Number 3. Singapore's annual core CPI held steady at 3.1% in May, while headline inflation rose to 3.1% from 2.7% in April. Both were in line with expectations. ANZ head of Asia Research, Koon Goh, says a strong Singapore dollar helped drive monthly declines in a number of consumer goods, although services prices remained elevated.
Overall, core inflation is still elevated at over 3%, where it has been hovering for the last 5 months. This is still well above the long-term average, which is the de facto target for the MAS. Therefore, MAS is likely to continue to keep policy unchanged for the rest of this year, as a strong Sing dollar is still required in order to help dampen inflation pressures.
Number 4. New Zealand's merchandise trade balance delivered a surplus in May, as exports rose 2.9% from a year ago. But ANZ agriculture economist Susan Kilsby says falls in some import categories highlighted weaknesses in parts of the economy.
There are a number of sectors that aren't doing so well. So yes, certainly vehicles and machinery are pretty weak. Iron's pretty weak, indicating, we're not seeing a lot of construction activity at the moment. Fertiliser was another sector that was particularly weak, certainly indicating that we're just seeing a lot of cutting back and spending in the agriculture sector. So those sectors were all quite weak.
Number 5. Malaysia's headline CPI is expected to edge up to 1.9% annually in May. ANZ economist Arindam Chakraborty says today's data will cover the removal of a blanket subsidy for diesel, although low use will mitigate the effect on the CPI.
This is a prelude to a wider unwinding of blanket subsidies for the RON 95 fuel, which accounts for nearly 89% of total fuel consumption. This would have a more substantial impact on headline CPI. Also, given that targeted subsidies will remain in place, the second-round effects of this fuel subsidy rationalization are likely to be minimal. We think that the central bank will view it as a one-time adjustment, and it's unlikely to trigger monetary policy action.
Arundam Chakraborty there. Now, in our bonus deep dive interview, ANZ's senior rate strategist Jack Chambers looks at how the Reserve Bank of Australia's tone has become more hawkish at a time other central banks have started to ease policy.
We got a bit of a dovish shift across central banks that communicated last week, particularly from the Swiss National Bank, which surprised by easing by 25 points. And the Bank of England didn't move, but it turned out to be a bit more dovish than markets had anticipated. And we've seen a rally in UK government bonds and a softening in the sterling in response to that. I think what this does is it fits in with the broader narrative that central banks, whilst they may begin easing cycles, have already commenced easing cycles, in the case of the SNB, they're very much in a data-dependent, seeing how the economy evolves, not on a preset path towards easing by particular dates or going at easing at consecutive meetings. So I think, if you look at our view, is we still have the Bank of England beginning its easing cycle in August, which the market's a bit more than 50% priced for now. We'll need to see a bit more softening in inflation data, particularly services inflation, which is proving to be a bit more sticky than would be liked in the UK. And then in Europe as well, we still have them easing, or the European Central Bank easing again by September of this year, followed by another cut in December. So 50 basis points of additional cuts in addition to the one that's already occurred by the end of the year. But again, that depends a bit on the data flow. We saw with the PMI data on Friday, there was some softening in activity in Europe, led by France, which might be explained a bit by some of the political uncertainty there. But at the same time, inflation outcomes in Europe have proven to be a bit more sticky than would be liked. So you have that a bit of a bifurcation between activity, which is softening, and then prices, which are proving to be a bit stickier than central banks would like to see.
And looking at this part of the world, what's the story in Australia at the moment?
So the RBA is actually a bit of an outlier compared to some of the other G10 central banks, where it turned out to be a bit more hawkish, and that was reaffirmed in both the post-meeting statement from the board and then in Governor Bullock's post-meeting press conference, where she talked very explicitly that the board considered a hike. Now, it's unclear whether this was the RBA seriously considered hiking or whether it was just a means of jawboning, because what we know is going to happen in Q3, and in the matter of actually just over a week, is that there will be a boost to real household disposable incomes, partly through the stage 3 tax cuts, which provide a tax cut to all taxpayers, and then energy price subsidies, which vary depending on what state someone's in. But we do know there's going to be a boost to household incomes, and I think the RBA is wary that that leads to a large boost in consumption, which then has knock-on effects for inflation.
Jack Chambers there. I'm Alex Tarrant, standing in for Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, June the 25th. Catch you tomorrow with a look ahead to Australia's CPI indicator for May.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.